I'm Charlotte McLeod with investingnews.com, and here today with me is Joe Cavatoni, Senior Market Strategist Americas at the World Gold Council. Thank you so much for being here. Great to have you as always.
It's great to be here, Charlotte. Thanks for having me back.
Of course, always so good to be catching up with you. And it's only been a couple of months since we last talked, but there's been a lot going on with gold. We've seen the gold price get up to new all-time highs, then pull back. And of course, last week we had a little bit of a rebound as the government shutdown in the US came to an end. So I'm hoping you can start by helping us unpack the key gold drivers that you are watching right now.
Sure. I think you've encapsulated it pretty well, which is we're having record-setting levels that are touching and coming back off as really what I think is at the heart of all of this. Risk and uncertainty continues to get measured not only by investors in the East, but now Western investors more prominently in the U.S., trying to understand what risk assets in their portfolio will look like, how they'll perform. We've had pullback in equity markets now, and actually you're starting to see the pronounced interest in gold really take hold. And again, the investor interest is what's really moving us now.
Yeah, I think we're definitely going to get into that investor interest angle. I want to unpack a little bit more before we go there what's happening with the government shutdown. So as we know, economic data has been quite scarce during this time, and we're preparing right now to hopefully receive some more of it. So I'm wondering what you may be watching most closely in terms of that data coming out of the US.
Yeah, I think it's a really interesting point. With a lot of the challenges that have been created as a result of the U.S. activity in terms of trade relations, tariffs, and even a shutdown, what you end up with is risk and uncertainty, the ability for people to understand that, gauge that, becoming much more challenging as data has been withheld or is incapable of being produced for us. So those are looking at that data intently, trying to get a gauge of how the Fed likely will react, or even just looking at data in general. For example, we haven't even seen the appropriate reports out of the CME in terms of open interest, in terms of the open interest contracts. So all this data is missing from our day. It's missing from our analysis. So we're actually left a little bit blind trying to make the decision. So I think it's just made decision making more complicated. It's made risk and uncertainty higher. But now that we are back open, at least until January 30th of next year, we're hoping that the data will come to us. It's a big week for data this week in terms of just different factors that people are going to be looking at. And that'll help us gauge whether or not the Fed looks likely to make a rate cut in December. And now look, they're cautioning too. They're saying, be careful. No foregone conclusions here. So I've not seen them that's outspoken about rate cuts to date. So it's actually been quite interesting to see how they're responding.
It has been quite interesting and great point. The Fed is also looking closely for this data that we're all waiting for. Do you have any thoughts at the moment in terms of which way the Fed may lean in December? I know, as you just said, it seems that officials at the Fed are divided. Any initial thoughts from you that you can share right now?
I think it's a little hard to judge right now without that clean, clear data giving us an indication. I would have been in the camp of saying I would have expected rate cuts to take place in December. But again, I'm going to basically step back and let the Fed speak to us once we see more on the data front. They're signaling, don't be so quick to conclude and don't position around concluding that there will be a rate cut. I think they're just trying to be very careful and cautious. But right now, I think that employment is a big key for them, and I think they're trying to really land on what the situation looks like. But they're also hell-bent on making sure that the inflation number is in control.
I'm just back from the New Orleans Investment Conference, and of course, we're covering many topics there as well. And one point that came up frequently was the end of quantitative tightening and the potential start of quantitative easing in 2026 from the Fed. So I wonder if that's something that's on your radar. Any thoughts you would share on that note?
Yeah, I think it's definitely hitting the radar. It's early to tell at this stage. And I think that right now, the question of how the Fed basically deploys its balance sheet is a big key component right now. I think we have to just take time and let data come through, let the market settle in a bit. I think what's more interesting to keep an eye on than just the Fed's action are company behaviors as a consequence of rates where they are today and the prolonged risk that could play out with bond issuance and the cost of sustainability of these debt levels that these companies have, how that factors into the risk of like individual assets and risk in terms of equities and bonds more specifically. Because I think right now, as people think through the gold transaction, they think through the gold allocation, they are looking at the shock factor that comes into their portfolio when risk moves. And when risk moves, it moves pretty substantially. And I think right now they're looking at gold and saying, hey, look, if I need that safe haven, how should I think about it? That discussion around the Fed and their balance sheet, that's a longer term trajectory in terms of a discussion to have.
Well, and maybe we talk a little bit more about how investors are adjusting their portfolios as they see this situation playing out. I know the World Gold Council recently had the latest demand trends report come out, and I believe it notes that Q3 was a record quarter for demand. So I'm wondering if you can unpack that and explain where that was coming from.
Sure. I think for sure it was a record for demand, not only in tonnage, but also in terms of dollars spent to accumulate the gold, which is actually obvious once you say it after you look at where the price is. But right now, the big driving factor has been investment. It's been investment on a global scale. In particular, it's coming through in what we saw as a record quarter for ETF flows. Now, this is a space in the market where we've been talking about how it's been flat to down in terms of tonnage uptake. Dollars have been flat to up in terms of accumulation over the last couple of years. But now, at this stage, what we're seeing are record flows, not only in North America, but also in the Asian market. And actually Q3 and Europe was strong as well. You're looking at a record amount of flow in not only the quarter, but also in the month of September. As investors are simply saying, like I said, looking at this moment of market correction, market risk, am I looking at a potential for a bubble to pop and looking to definitely buy the right kind of allocation of gold into their portfolio?
So we've got now the Q3 numbers, and I know it's of course too early to look at 2025 as a whole, but is there anything you can say in terms of the demand numbers that you've been seeing? Can you say anything about what the full 2025 year could end up looking like?
Yeah, I think it's a good question. And obviously it's one that's on everyone's mind as we kind of get our monthly updates on data that we can get, like central bank demand and also ETF flows. You're seeing those two areas very strong. They're continuing to be strong. So that means that demand in the investment space and demand with central banks, again, top notch in terms of what we're seeing and what we're expecting in terms of the trajectory. I think we'll likely come in a little below where we've seen the last 3 years for central banks, but not by much, and well in excess of what we've seen in terms of the 15-year, 16-year trend. The area that we definitely know we're seeing some softness and we'll continue to see the softness is in jewelry. And I think it's interesting for us to see we have some seasonality that can play out in quarter four, whether that's through special holiday seasons in the Asian region or actually going into the holiday season here in the US or Western markets or global. But let's see if the seasonality has had an impact on the jewelry demand. Our instinct right now is telling us that these high prices and actually caution around investing in something like jewelry might still keep it suppressed. The only other factor that I'd raise for you, Charlotte, in terms of the demand flows is also just thinking on the other side, supply, and that fabrication side, that actual side of recycling still isn't as large as maybe you would have expected in an environment where you have higher gold prices and likely people putting gold forward. So I think people are still hanging on to their gold. They're not actually looking to liquidate and take the money. They're sitting back and saying, hey, maybe there's more room for this to go.
Well, that's quite an interesting point in and of itself. And one other point that I wanted to note with you, as we're seeing more people come into the gold market, I'm noticing that people who have been in the sector for a while and investing in gold for some time are maybe a little bit nervous to see this more widespread interest, where they're used to seeing gold as a contrarian play. And now with this wider recognition of gold, it makes them feel a little nervous. So I'm curious what you might say to somebody who's feeling like that.
It's a really interesting point. I think that in addition to what you're highlighting in terms of those that have been there for a while and talking about the gold market, you hear that as well from those that have traded the markets as well. Like, these numbers are too high. They don't make any sense. We don't see the flows we've normally seen. And I think what people need to understand is a couple of different factors that are at play here. Number one, portfolio resilience and the actual interest in investors to understand how to make their portfolio as airtight as possible, which means including gold in real assets and alternatives at the consulting level and at the level of allocation analysis. That's a shift. That's a shift in mindset that investors have taken on. That hasn't existed until today. So that's a big shift in the resilience question from investors. And it's global too, by the way. Not just a Western phenomenon. It's a global phenomenon for investment. Secondly, I think the structural shift that central banks are talking to about adding gold as a component of their reserve portfolios. Now, you can argue whether it's debasement or de-dollarization or fear of sanctions or whatever the case may be. The numbers speak for themselves. That structural shift of saying there are no viable alternatives to the dollar or dollar-based assets, so I'm looking at gold as that viable alternative. That's number one. That's number two in terms of the pronounced kind of shift and change. So when we talk to people and we say, yes, we haven't seen these numbers before, we haven't seen these highs before, look at the data, look at the driving factors behind the use cases, and you're going to understand that there's a shift here, which should give you comfort and confidence to make a decision on your entry point into the market and why you should be looking at gold and holding it longer term. Not just looking to do the trade. You could have had a trade that you could have done last week where you could have made 5% in, 5% out. And actually, we're not encouraging people to look at gold that way. If you want to trade it, you can. We're looking at the structural allocation that people should be putting into their portfolio. And over the long term, you've got returns that rival that of equities at about 8 to 10%.
Well, and talking a little bit more about this mainstream gold that's happening right now, I wonder if you can talk a little bit more about maybe just how far that could end up going, because one of the headlines that I've seen a lot is Morgan Stanley and the 60-20-20 portfolio. And if more people go in that kind of direction, that seems like it could be huge. And it seems like we're just in the beginning of everything that's going on for gold. So any comments on that?
Yeah, I think you're right. And look, if you look at consensus, broad range consensus for the price outlook for gold amongst the leading analysts in the world, for 2026, they range from 4,000 up to 5,300. So you're looking at a price appreciation of a reasonable level over the course of 2026. Now, those numbers are just that. They're expectations of where the price could go. And I think fundamentally what you have to understand in that case is that the more that people are investing in gold, the more they're understanding its role, the more that there's a likelihood that the price support will continue to grow. And I think right now, when it comes to allocations and it comes to understanding risk in a portfolio, that 20% that Morgan Stanley's amplifying is just that. It's saying, look, what are alternative ways for us to protect the portfolio while maintaining growth? And it's actually looking at gold in that light. So you're looking at something that's got the right kind of correlation behavior and the right kind of diversification benefits. And I think they're looking at it in the context of that allocation versus just staying in bonds and equities and the correlation behaviors of those two assets. And I think this is a really interesting time for us because gold is a monetary metal. Look, we didn't make it as a critical mineral on the review by the U.S. government because we're a monetary metal. Silver, copper, all made it. Gold didn't. But at this point, we're looking at the monetary nature of what we do and how we play a role in the economies on a global scale.
And I think maybe the flip side of that more wide recognition of gold that we've been talking about is, I know you've talked to us in the past about concerns about the dollar, and another headline grabber that I've been noticing recently is talk about the debasement trade. That seems to be getting more wide recognition as well. So I'm wondering if there is anything you would point out there or on your outlook for the dollar as we're moving forward into the next year.
Yeah, I think it boils down to a number of key factors. One, how the U.S. economy lands itself in terms of whether it lands soft or hard. I think ultimately what it looks in terms of the outlook for the dollar, can the president engineer what he wants, which is job creation, job growth here in the U.S., low inflation, and actually a stronger dollar through the whole process, with trade relationships being renegotiated as we speak. So it's a complicated scenario, but it's not inconceivable to see that the dollar could remain strong. But even in that set of circumstances, it's not the only driving factor that's going to actually impact the gold market. You have to look around the globe at some of the other areas where you have large consumption of gold. So, we've had a strong dollar and a gold market that performed well over the course of 24 into 25. And actually what you basically are seeing is Eastern investors driving the flow, Eastern consumers driving the actual demand in gold. So you have to look at those economies as well. So I'm not worried that the dollar strength or weakness will be the only factor that will impact the gold price. I think it'll be a factor to keep a close watch on. As I previously mentioned, I think the debasement trade is to be debated. It's not necessary to put a label on things. I think at the end of the day, if central banks see an alternative to the dollar in terms of growing their dollar-based assets or actually looking at other assets, gold's playing that role there. So I think at this stage, what you see are the dollar-based assets and gold playing a key component of reserve portfolios. And I think that that's actually probably the most important point to note. Gold's playing an additional role in the reserve portfolio context.
Yeah, I think that's a really key point to note. And as we're getting toward the end here, we're also coming to the end of 2025. We're looking forward to 2026. And I thought maybe this can be a bit of a fun question. If you look back at 2025, how would you sum up the year for gold? And what are you expecting to see in 2026 if you look at it in a little bit of a concise way?
So I think if I were to look back at 2025, busy, but very good. I think the performance of gold speaks volumes about the global perspective on risk and uncertainty. And I keep saying those terms over and over again. I hope they sink in with your investor base and your listener base, because that's an important element. Thinking about what the risk and uncertainty we've had to face over the course of 2025. And will that be easier or harder to assess into 2026? My sense is that we're going to continue to see these challenges in 2026. We're going to continue to see these unknowns surface as problems or just risk in markets. And I think right now, if you look at consensus views on the price of gold, investors, central banks, and look, jewelry's holding water. It's not a problem in terms of the demand profile. There's going to be a continued interest in these levels of consumption. So I think that that's what I'd look out at. Risk and uncertainty is what we've had to deal with over 2025, and it looks likely into 2026.
Yeah, I would say 100% that looks like it's going to continue into the next year. And just a final thought, I know that you don't do price predictions, but I know just given the price activity that we've seen recently, there are people who are wondering and thinking, all right, well, did I miss the boat on gold? So as we are wrapping up, any final thoughts you would share on that note?
I think everyone should look at the price of gold. They should look at the gold allocation component and what it could mean to their portfolio. And actually, what you're going to see are volatilities a little bit higher in the gold market between now and the next catalyst for the gold move. I think ultimately understand what role it can play in your portfolio. And actually, you can test the gold market up or down 5, 10, 15%, see how it performs, and also look at shocking the other risk assets you have in your portfolio. So have you missed the boat? Absolutely not. You just need to pick your entry point, be smart about it. But before you do that, make sure you understand what it could mean for your portfolio in terms of an allocation. And I think that that's what I'd encourage people to keep doing, even at these prices. And again, market consensus tells us, for 2026, over the course of the year, you're looking at a 4,000 to the 5,300 range. That's actually in line with where we are now at 4,000. So if you're flat for the year on the worst case scenario, that's a reasonably good outcome in terms of holding water in a portfolio.
Well, I think those are perfect words to end on. So thank you so much for coming on. As always, great to have you.
Thanks for having me, Charlotte.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. And this is Joe Cavatoni with the World Gold Council.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.